My trading account was up 500% in 2024. My second account is up 240%. And before you think to yourself, this guy is a big-brained giga-chad, well, sorry to disappoint, but my third account was down 50%. I also have a retirement account, but my approach in that one is the super boring boomer approach, so I'll skip it. Regarding the performance of my accounts, I know you're probably thinking this pleb just got lucky gambling, and you know what? To a certain degree, you're right. However, I think there's just a little method to the madness. So let's talk about it. How did I do it, and what were the takeaways and lessons learned? Here's the data for my first account. This portfolio has gone up almost 500% in the span of the past year. You can see in the breakdown section that, surprise, surprise, it leans very heavily into options. I mean, sure, you could pick a unicorn stock and probably achieve the same returns in pure straight up equity, but realistically, it's gotta be options for these types of returns. And here's my second account. You can see the gray line is how much I've put in, and the blue line is the total value of investments. In total, I've put in around 15K, and the portfolio has grown to over 40K, a gain of 240%. My third account, ironically, doesn't even have options enabled, yet your boy still took a 90% loss in early 2024. Like, that in its own way, I think is really impressive. I mean, really, think about it. That said, I've managed to claw back to now only being down 55%. And honestly, I'll take that. It could be a lot worse. So how did I get wrecked so hard on this account? Well, spoiler alert, it's in my past videos, but to save you some time, I got giga greedy and degened full ported into a controversial biotech. But not only that, it's a derivative of it, which is so much worse. Yeah, it sounds really regarded saying that out loud, but hey, you live and learn. And oh boy, I certainly learned. Okay, that's enough of the losses. Let's talk about some wins. My big wins in the past year I can attribute to only a handful of tickers. Reddit was by far my biggest win. I had short-term out-the-money call options as well as out-the-money leaps going into earnings call in October. I made around 7 times return on those options, and what's even more crazy is that they'd be close to 15 times if I had diamond-handed. Yeah, that's a big feels bad, man, but I'll definitely take it. My thesis around Reddit was pretty simple and straightforward. The sentiment around the stock was really bad. Like, we're talking 95% of people on Wall Street Bets, and other subreddits were constantly shitting on it. Next, I myself use it, and many people I know uses it. Furthermore, Reddit's valuation at the time was less than Pinterest and Snapchat, which didn't make any sense to me, considering the traffic that Reddit gets. Last but not least, AI and their need for data was a big theme and tailwind, and I saw Reddit as a huge beneficiary. The other stocks, quite frankly, were all election related. For instance, I had multi-baggers on crypto equities like Mara, Neptune Digital, Defi Technologies, MicroStrategy, and iBit. I was in and out of them, but captured the bulk of the recent Bitcoin and crypto appreciation. My thesis was essentially related to Trump and his family being pro-crypto, the increased institutional adoption of the asset class, and the 4-year cycle. You really don't need to overcomplicate it, in my opinion. Robinhood is another stock that's done really well for me. I was actually late and entered into a leveraged position in the fall of 2024. Again, related to the theme of deregulation with the new administration, and also because the Robinhood team is just crushing it at the moment. I absolutely love their vision and execution. Furthermore, the subscription model is just so smart, and they're doing comparable crypto volumes to Coinbase, which I don't think people appreciate enough. My other large winner was in Tesla. Again, I got into it late, sometime after elections result, but hey, better late than never. The reason for buying Tesla, I think, is pretty obvious. And last but not least, my Sava leaps returned over 100%. Luckily, I exited just before the data readout. This is a super high level summary of my DD and research. I could probably make a lengthy video on each of these tickers to go into detail, like the one I made on Neptune, but I won't bore you with the details here. Now, these returns are cool and all, but what I think is significantly more important is the logic and thought process, as well as the mistakes and lessons learned. I think you know that saying, teach a man how to fish, yada yada. So here it is, my thoughts, reflections, learnings, and mistakes. For some context, my IRL friends aren't interested in investing, whereas I'm the complete opposite. I find it very intellectually stimulating and fun. In fact, that's my reason for starting this channel in the first place, as an outlet to share what I enjoy doing and hopefully help someone else avoid some of the same mistakes I've made. And trust me, some are very, very costly. Like, we're talking 6 figures. To me, it's almost like a puzzle game. The cherry on top is that, as a natural part of the research, it forces us to learn about different topics, disciplines, sectors, technologies, and so on. It's also forced me to look more introspectively at myself, which admittedly isn't always easy, but you need to be aware of your flaws and biases. Otherwise, you'll get taken advantage of. The markets can be pretty brutal and ruthless. Now, don't get me wrong, the money-making part is great as well, but I truly believe if you're just in it for the money, you will burn out. This is a funny story. I was actually browsing Wall Street Bets daily back before the whole GME saga. Keep in mind that I didn't even have a brokerage account during this period, thanks to student loans. I was just reading some of the DDs on there for fun. Some were actually really good and ended up printing. And that's when I realized the efficient market hypothesis we were taught in school is complete BS. There's a ton of alpha out there, and many things are in fact not priced in. So with that said, here's some of the things that's worked for me so far and some general commentary. First, just don't overtrade. If there's no opportunity, there's nothing wrong with just chilling in cash or index funds. I've tried force trading before and it has not worked in my favor historically. And related to this topic, when opportunities arise, you need a prepared mind and, just as importantly, the conviction to put on size. I think this is what really separates the amateurs from the greats, like Drunken Miller. That said, it involves a lot of prep work and research beforehand. Again, I want to emphasize, you absolutely need conviction in your positions. Some of my call option positions had plummeted over 50%. Without conviction and DD, I would have paper-handed those positions. Next, I've noticed the markets are set up in a way to capitalize on emotions and sentiments. Put another way, it's intentionally set up to take the money from the quote-unquote suckers. Don't be a sucker, which leads me to my next point, managing emotions. I can't understate just how important this is. This means don't blind FOMO or paper hand at the first drawdown. In fact, you should expect to get punched in the face after entering into a position and say, "Ooh, that hurts. Give me more." It's really counterintuitive and goes against the natural human programming, but that's typically when it's worked out well in my personal experience. Admittedly, this is something that I still struggle with at times. The natural human programming goes pretty deep, and there's a great quote that really sticks with me because it is so true. In investing, your stomach is more important than your brain. This may sound weird, but for me, exiting my position is oftentimes much more challenging than entering into them. And what I've learned the hard way is to not get greedy and take profits on the way up. But even more importantly, you have to let your winners ride. Related to this concept, my opinion on college is pretty mixed, and there's very little that still sticks with me course content-wise. However, the following I learned in behavioral finance is one of the few exceptions, and through my personal experience, I can confirm it to be true. Through a ton of empirical research, studies have concluded that as a part of natural human nature, we have a natural inclination to average down into our losing trades and sell our winners early, when really we should be doing the complete opposite, which is to cut our losers and let the winners ride. Of course, this is a general statement and many times is not applicable. This again circles back to human nature and psychology. I'd elaborate, but this probably isn't the video to go into length on this. I think what's important is to be aware of our natural biases. For me personally, I find it helpful to zoom out and to not get lost in the details of it all, whether that's technicals or whatever else. For instance, in retrospect, the elections trade was probably the easiest trade, literally multi-bagger opportunities everywhere. And the best part is you could have entered into those positions after the results were announced. For example, in the case with Tesla, Musk went full degen and risked it all on Trump winning, which honestly I can respect. It takes balls. And also for Bitcoin and crypto, Trump had made public comments about Bitcoin and establishing a Bitcoin reserve. Also, his family is very pro-crypto. What I've learned through my experience is that you only need a couple big winners. Heck, even one is enough, to be honest, to significantly outperform. The Nasdaq is my benchmark. If I can't consistently beat it, then there's no point to doing this. Interestingly, it's not about the frequency of your wins. In fact, over half of my trades were losses, but rather the magnitude and asymmetric wins. For me, that was Reddit, Tesla, and crypto. Finally, I realize my approach is not for everyone. In fact, I'd say most people are better off investing in the Nasdaq and not have to think about any of this stuff. If you're watching this though, I'd imagine you're probably not like most people. I realize I'm fortunate in that I'm naturally drawn to the game and can appreciate its ups and downs, and above all, enjoy the process of learning and improving. So thank you so much for watching. I've got a few other ideas that I'm currently working through and researching. If you found this interesting, stay tuned. There's more to come. Cheers.